It's no secret that it can be difficult for student loan borrowers to manage both making their debt payments and saving for retirement. Student loans come with a minimum monthly payment that borrowers have to meet to keep their loans, and as a result, their credit history in good standing. While there's no requirement to contribute to a 401k or other retirement account, it's smart to get started on saving early. Consequently, those with student loan payments contribute at a lower rate and have smaller overall balances in their 401k accounts. A study from the Employee Benefit Research Institute recently confirmed. The study examined the retirement savings habits of more than 50,000 participants between 2017 and 2019 to see how student loan payments affected their contributions. While a higher salary does correlate with higher 401k balances and contribution rates overall, it doesn't close the gap between those making student loan payments and those who aren't making such payments. The difference in 401k account balances was especially pronounced among those who earn $55,000 a year or more, compared with those earning less. In fact, employees with student loan payments who earn $55,000 a year or more and have been at their company for 5 years or less have average 401k balances 36% lower than those without payments, the EBRI found. Naturally, employees consistently had higher average 401k account balances the longer they'd been with a company and the higher their salary, regardless of student loan payment status, the EBRI found. But the gap between balances for those making student loan payments and those who aren't is surprisingly smaller among lower earning employees than higher earners. For employees earning less than $55,000 a year, those without student loan payments had balances about 4.5% higher on average than those with student loan payments, regardless of tenure. Change in payment status slightly affects 401k contributions. When they were able to stop making student loan payments, 32% of employees increased their 401k contributions, the study found. It examined participants' behaviors from 2017 to 2019. So the stopping or resuming of student loan payments was due to individual circumstances, not the COVID-19 pandemic forbearance that paused all payments for federal borrowers. Across income groups, employees changed their 401k contributions at similar rates when their student loan payments ended, though lower earners were slightly more likely to increase their withholding. Just 31% of employees earning $55,000 a year or more increased their 401k contributions when they stopped making student loan payments, compared with 33% of those earning smaller salaries. Lower earners were also less likely to reduce their contributions when they started making student loan payments. Just 21% of those earning less than $55,000 lowered their 401k contributions as they started making payments, compared with 29% of the higher earning group, the EBRI found. It's less disposable income that borrowers have, so it's likely a fear reaction. Sam Silberstein, a certified financial planner and certified student loan professional with Student Loan Planner, tells CNBC Make It. A lot of people reduce retirement contributions before they even feel the impact of the student loan payments. However, the size of the initial contribution rate may play a factor too. Those contributing at higher rates may have more wiggle room. Silberstein says it makes sense, especially for lower earners, to look to their payroll deductions when they need to make room in their budget for student loan payments. Your first reaction is going to be money that you don't necessarily see come into your bank account, such as automatic salary deferments to retirement, she says.